The charts themselves, they're continuing to tell me that while we'll have some of these big bear market rallies, we are entering a bear market, which, by the way, makes a lot of sense, right? Everyone's like, oh, don't fight the Fed from March 20, actually really from 2009 all the way up to 2021, because they were constantly printing money. Well, now they're doing the opposite. So when you hear don't fight the Fed, it actually is kind of meaning, don't be long the market, or at least don't be long-term long the market at this point. So keep that in mind, is that narrative, that kind of thought process of don't fighting the Fed or don't fight the Fed is very accurate on the way up, but it's also accurate on the way down, even though people don't want to take that advice, right? We always want to be in the market. We always want to be long stocks. So you're absolutely right that there's emotion. I mean, we're human beings, right? So we're always emotional. That's how we are. And that's actually a good thing in life, right? I mean, you want to have empathy, sympathy, and all those great emotions that make us good human beings. In trading, it happens to work against us. It makes us want to freak out and dump at lows, and it makes us want to chase longs when they're at all-time highs. And really, for me, the only way I've been able to kind of master it, at least, to a certain point, and listen, you always, like you said, there's always going to be a little part of you that gets emotional or gets nervous or gets fearful, but it's about the repetition of it, and it's about just doing it for so long, where you start to see these things where when the fear gets to a certain level, your brain starts remembering the last 20 or 30 or 50 times when that happened, and you remember, oh, wait a minute, that was when things actually bottomed out, and vice versa on the upside, when things topped out with intense greed. So for instance, you look at cryptocurrency in 2021, and for me, I vividly remember the same things being said about the dot-com bubble, how it was a changing world technology, how this was going to just go on forever. And and then you look at like Dogecoin and some of these meme coins, and 19,000 coins out there that are all, that really have very little use case. And it's so similar to the dot-coms that, were a lot of junk. A lot of them were junk. There were a few gems in there like Amazon, but it's so similar. And you get to this point where you start to kind of see the patterns repeating and the psychological psyche getting repeated over and over again. So I think that's the best thing, is that repetition to the charts. And I say, okay, if I'm looking to buy this, but it's so scary to buy, what are my factors? Let me write them on a piece of paper so that I can see them in front of me. Okay, it's a double bottom. It has major support from the yearly chart. It has an oversold signal here. The RSI maybe is below 20 at this point. And you start to kind of align these logical factors that can kind of keep you on an even keel for trying to not get too emotional. In those situations, like a crash of 87 type situation, I'm just as likely as anyone to get caught on the wrong side. When you have these black swan, very quick situations, like today, I was slowly inching in a bunch of these tech names that have been beaten down with the concept that they're oversold near term. Maybe they go a little bit lower next week, and then I kind of accumulate them a little bit more. But if we got some sort of situation where all of a sudden everything dumped out 20%, I'm getting caught off guard just like everyone else. The way I mitigate that slightly is I'm very cognizant of how much money I'm putting in each trade. So for instance, I'm starting my positions with like 1% of my portfolio. Now I spread out 1% in some Zoom, 1% in some Teladoc, 1% in Facebook. And so, overall, it might be 10% total, but it leaves me a lot of maneuverability in case I am wrong in the near term, because picking bottoms and tops is so hard. We all know that. But if you kind of inch in and you find these technical levels, maybe the first technical level doesn't bounce, maybe the second, but by the third, the probabilities are in your favor for that bounce. So accumulating slowly does work. But yeah, in those crazy events, it's so hard to not get to that point of being, wrong in those situations. And I think position size is the only way to mitigate that slightly.
That's it for today, guys. If you found this video useful, then don't forget to like the video and share this knowledge with your friends and family. And don't forget to check out the full video. Link is in the description. Thank you.